What was your take on today's rally? I mean, are you selling into it or just sitting back and watching it?
No, I'm just sitting back and watching it. You know, it's if you've been waiting on the sidelines. So I'm long. I'm always long. I was long as it was going down, and I'm long right now. Nothing's changed. But if you're sitting on the sidelines, there you go. Nice job, Inglewood Cliffs. If you've been sitting on the sidelines waiting, I want to wait till it, bottoms out and then I'll jump in. It's really hard to do on an up 1,100 day. So, now people feel like, oh, shoot, I missed it. I'll have to wait again. I don't know. We'll see what kind of follow through there is. I agree with Tim. I thought the reaction to what was nice, a little cool data from CPI. That's good. We haven't seen that in a while. I still think, rates are high. But now we're getting out of earnings season. So some of these macro things can whip us around a lot more easily. The dollar moved today, though. That was big. That counts for something.
Yeah, so dollar lower, yields lower. You saw crude oil didn't rally today. Those are all really good things for an equity rally. I agree with all of you guys. I just think it was a little too much. And it just shows you, though, how wound we were, how poor sentiment was. And, again, coming out of earnings season, I mean, just go back a week and a half. I mean, all of the biggest names in the market, for the most part, disappointed, guided down. Estimates came down. We're starting to see 2023 S&P estimates come down. Those are all good things. We've been talking about this. It's like, okay, we were waiting for this sort of stuff all year long. So, for me, I guess we've been talking about it on the show. I just thought some of the disconnects after earnings in a bunch of names, and Disney was one of them we talked about early in the week. I bought it at $86.50 a day or so after the results. I bought some Meta after the results. I bought Google after the results. I bought Amazon after the results. I bought Snap after the results.
You bought Meta?
Yeah. So I guess my point is like, I'm looking at it more from a trading perspective, okay? I wasn't long these things prior. I didn't have any conviction that they do. What I did have conviction is when the sentiment's so bad, after you have wholesale selling and names like that, you will have the potential for a gap fill. That, to me, is the unique opportunity that you have in markets like this. And again, we are still in a bear market. If you look at the S&P or you look at the NASDAQ, we're still in a 2-month range, which is well below the range for the prior, 8 months or so.
How much of today was short covered?
Sure.
Some really heavily shorted stocks rose 30%.
No, maybe. But I guess the one thing I was saying, we've been talking about like the VIX, like what, we don't see the VIX go over 35. The people that short stocks seem fairly well hedged up for all intents and purposes. So, yeah.
You're not hedging at 35 VIX, that's for sure. Yeah. And at a 23 VIX, which is about to where we're going to get to, is something that I'm not sure is appropriate relative to where the market is here.
We put so much emphasis on, Fed, what are they going to do, and does this give them cover? I think it gives them cover to speak more hawkishly, number one, which is a good thing. But again, the market going lower is not all predicated on a Federal Reserve. I mean, earnings have not been particularly robust. We're still in a slowing period of growth. You shouldn't pay as much on a multiple for S&P 500 earnings, which are going lower. So there's still the market move today didn't cure the ills of all these corporations that are feeling the heat, as are a lot of the consumers.
But did it change? But as we said earlier in the network today, or I did, lower yields, and we saw yields go down a little bit, do change how you discount cash flow. They can affect multiples.
Yeah.
Was today sort of just that multiple adjustment, and that's it? I mean, I wonder if today was all we're going to get from the Fed pivot.
I thought that multiple adjustment was overdone relative to...
Overdone on the downside?
No, overdone sort of to the upside. I think rates are still high. They are a little lower, but they are still high compared to where they were a year ago, November, and you could, multiples of... You could trade at any multiple. But I thought the interesting thing to me was the home building move today, that whole space.
Like everything's fine. Suddenly everything's fine in home building.
I think now we were looking through to, all right, we can see 6 months out. Maybe that gets better.
But to me, the housing market where the velocity is going to be zero, okay? I mean, even if rates came down a little bit today, I just don't see how the housing market, and I can look at home builders and see multiples that are actually really attractive relative to their history and all that. I just think you have a case where we've gotten through multiple phases of this rally, and the two most important ones we haven't even gotten to yet, and that's a credit crisis and that's a liquidity crisis. And so the fact that we've had this greatest trading market of all time or the last handful of years, which is what I think it's been, is part of the dynamic of what people's expectations are of where we're supposed to go. There's no sign of a credit crisis anytime in the next few months.